Hi, this is Randy Finney with Right Side of the Chart, and today's Friday, May 18th, 2018. This video is actually the second draft. First one got into it was a little bit long, so I cut it off. I figured I'd try to condense this and try to keep these videos under 20 minutes if possible. What I want to do today in this one is go over the weekly charts. We'll only stick with the weekly time frame, and I wanted to do a start out with an overview of the U.S. equity markets, not just any one particular index. We'll just cover the big ones. We'll cover the S&P 500, Nasdaq 100. I might touch on a couple of the equal weighted indices. We'll cover the Nasdaq Composite, mid caps and small caps. And then at that point, I'll just move on. I wanted to cover about the top dozen or so holdings in the S&P 500. Yesterday in the trading room, I made mention that I'd started to comb through the charts of the S&P 500 components, and as I went through the charts, I'm seeing more and more evidence that supports my case. I haven't wavered. That we're probably looking at a substantial correction, bigger than what we've already seen this year. Most likely a bear market, a drop of 20% or more, coming sometime this year in 2018. It's possible it already started, very possible that it already started, but we're not there yet. So what I'm going to cover are some key levels, key technical levels to watch, key developments to watch for, and most importantly, I want to drive home the point that if and when those levels go, and I've said this before, things happen very fast. Stocks tend to fall much faster than they rise, and when long-term, very important support levels and trend lines break, and then what happens, they all do it in proximity. You won't see the large caps break down and drop 10, 15% without the small and mid caps following. And then when you have that type of impulsive selling, the old saying, the baby gets thrown out with the bathwater. It doesn't matter how good a company's fundamentals are. If they're a big component, tied in with the indexes, index fund like, Amazon, Apple, Microsoft, forced selling brings them down. And again, that's not to say there's always that there aren't some stocks that can go up during a correction or bear market. There's always some stock that's going against the trend or some sector. But that's the point I'm trying to make here is get your ducks in a row. Whether you're a long-term investor and you're talking 401k money that you've been in for a long time, it's doing well, and you want to know when to pull the plug. I can tell you this, that the technicals are continuing to look increasingly bearish right now. Long-term trend indicators remain bullish. We're above trend, but let's just get into the charts. I'll let you guys make the decision on what to do based on what I'm going over here. This is the S&P 500 we're going to start out with. This shows you the yellow line is what I call the primary uptrend line. Primary bull market uptrend line. It comes off the 2009 lows. March 2009 was when the last bear market ended for most indices. The Nasdaq 100 was a standout that actually bottomed in I think it was November of '08. Everything else, just about all other sectors and major indices bottomed in March of '09. So there it is. You can see it's pretty well defined, and it's also what I call the benefit of the doubt trend line. See, I had two trend lines here. These white trend lines. This marked the first leg of this bull market, and we had what's called it's not a very common term, but it's referred to as a deer market. A deer market is neither a bull nor a bear market. Bull markets obviously trend is bullish, stocks prices are rising. Bear markets are the opposite. Whereas a deer market is an extended period of a sideways trading range. We had one in the early 90s that really tied together. That was the longest bull market on history. This one's about to shatter that record. I don't know if we've done it yet or not. It's either way, we're right there. But that one, as with that one, this was connected with this deer market. Now, keep in mind, this period back here in 2015, we actually had, by technical definitions, we had bear markets in small cap stocks. I'm not sure if the Nasdaq Composite hit it. It might have, meaning a drop of 20% or more. The S&P 500 managed to avert a drop of 20% or more. It's more diversified, has a lot of defensive issue stocks, dividend payers, things that fall less than the higher beta tech stocks. But again, it's semantics. Whether you drop 20%, 21%, you can just look at this chart and say that was just a period of consolidation within a longer, bull market. And so, where are we at today on the S&P 500? that was that trend line, and this is the point I was trying to make. Once that trend line off the 2009 lows went, this was the primary uptrend line at the time. You can see the selling was very impulsive and very fast. You had in just 1 week, if I can zoom in there, I'm going to just rough estimate with the measuring tool, that was a drop of about almost 7% in 1 week, that big red candle. And that's how it works, guys. If you don't have a plan and you're not ready, especially when the markets are dancing in a very precarious technical position. I mean, we could go on to make new highs. I'm not a fear monger. I'm not trying to peddle, gloom and doom, but I'm pointing out that we are in a very precarious technical position. We have been for weeks now. We have been for months now. I've been saying the same thing, and that's because we haven't moved away from there. We need to get away from these trend lines. We need to firm up some of the technical indicators and give us a little room. And we could do that, but be on guard. That's what trading and investing is all about, especially when you're over 9 years into one of or the longest economic expansion and bull market in history. You're picking up nickels in front of a steamroller. We all know that economic cycles, recessions, and expansions are a natural part of the business cycle, and they always will be. So to make no mistake about that. And don't expect CNBC to tell you that a bear market's starting today or started last week, or even the government, because recessions have always been identified only in hindsight and only well after stocks are off their highs, and almost always when the market is already in a bear market phase, already dropped 20% or more. All right, so that's that. We need to use technical analysis, not fundamental analysis, to tell us that we're in a bear market or most likely, or even a correction for that matter. So we'll get off the S&P 500. One more thing I want to make mention. You can play your glass half empty, glass half full. Glass half full, meaning the bullish side. Well, okay, we're still above that trend line. We had a couple corrections, but prices have been moving higher, so the market refuses. We haven't taken out those lows from February and early April yet. The bulls can say that we've had a little correction, things got a little hot, but we're moving higher now. And you can also look down here and say, okay, the PPO, I can see it curling up and it's poised to make a bullish crossover. That's usually, especially on this weekly chart, that's a pretty good buy and sell signals. You can just do it yourself. Put a PPO, it's a close cousin of the MACD. There's a bearish crossover right there that came right after that first red candle. And again, you can go and do this on your own. However, I wanted to point something out. Just as if you followed me for a while, divergences are a big part of my trading. Negative and positive divergences often are a pretty accurate predictor of a trend change. But as I say, they're not the be all end all. Sometimes divergences are burned through. Much more often than not, if they're confirmed the way I like to see them confirmed, I might be a little more picky on my definition of a divergence, but when they're confirmed, much, much, much more often than not, they do play out. And the other thing here is a lot of people will use the MACD or the PPO, these bullish and bearish crossovers. So you might say, okay, it looks like a pending bullish crossover. Well, what I've done here is I've circled a few instances. Let's go back in time where the PPO had curled back up after we started at it. We had a little correction here. You can see back in May of 2011, market started to correct, and then we had a relief rally. This is where everybody gets bullish, said, oh, whew, we dodged a bullet there. Looked like things were getting ugly. We're down about 8% in the S&P 500, and then, oh, everything's good. Big green candle. Everybody gets excited. Market's going to new highs. PPO is turning up right here. Again, you can zoom in. I'll zoom in a little tighter for you. You can see the PPO slope turned up. It was poised to make a bullish crossover, but boom. And then this is what I'm talking about. This comes out of nowhere. What happens on these relief rallies? Smart money exits. They realize something's wrong. Take any theory you want, but this is usually the dumb money rally. Retail investors that were waiting to buy a dip. And then boom, then comes a big move down. So we may or may not have seen that yet. There were two shots across the bow like we've had so far. This was shot number one right here. This was shot number two, and then boom, there's the big drop. And that was from the highs there. So had you not sold your longs on that initial kickback rally or got in short, you were down, looks to be about 21, almost 21.5%. So I guess, yeah, I guess I was wrong. I thought the S&P 500 It had not fallen that much. So from high to low, it didn't close down over 20% or more, but it did intraday. As you can see there, 21% drop. Um, Again, right here, we actually made a bullish crossover. Let me move this RSI down. So you got your bullish crossover after initial leg down, and then boom, another big drop right there in the market, about 17 or more percent. And then right here on the flip side, there was looked to be an imminent bearish crossover. This came right at the after the end of the last bear market. Remember, we bottomed in March 2009 on that initial leg up, and everybody was still very bearish. We took a leg down. It looked like we had an impending bearish crossover, but it didn't happen. So my point is, a lot of times these are great buy and sell signals. The crossovers, again, replicated on your own. But fewer things in trading. I often say this: fewer things in investing and trading are more bearish than a failed bullish buy signal or chart pattern breakout. So for the bulls that are watching this now, if we get rejected, if this PPO line reverses and turns back down, and it coincides with a break of that trend line, that will be in my opinion, a pretty powerful sell signal in the U.S. stock markets. All right, let's move it along a little faster here. NDX, Nasdaq 100. Uh, as I said, that goes to the left of the chart. You have to, we bottomed in late 2008. But again, you have a well-defined, very well-defined trend line. There it is. There's the correction back here in 2015. And again, we went sideways for roughly 2 years. And that was about almost, you can see, we just missed that 20% mark there in the NASDAQ 100, about 19.32. And I'm referring to the red at the bottom of the pop-up box on the left in red, 19.32%. And then boom, there was another correction. And again, the bigger picture is from, you can see from about this point, I'll just grab it here to here. There's about almost 2 years. It was a good 2 years of sideways trading action. And then that launched, from there, from that period of consolidation, it launched that move off the 2016 lows. Almost all major indices have a trend line off the early 2016 lows and most sectors. And as you can see here, the NASDAQ 100 broke down. We've been back testing that trend line from below. Last week, we managed to close above it, but only marginally. Now, would you want to see an impulsive break if you regain a trend line? Right now, on today's Friday, we're going to close a week. We're trading on that trend line. So, and this isn't confirmation bias, but I wouldn't give, I wouldn't consider this a very bullish, or buy signal, just because we've limped back above that trend line. It's been not impulsively at all. But again, we're there, we're on trend. So you call it what you want. But if we start moving away from there, especially impulsively, that means basically what you had is a breakdown and a back test over the last couple months, and then a resumption of the downtrend. And obviously, I think we all know if we take out the lows from early February and early April, that would be a very bearish technical sign, and it will also have rejected. See these lines right here, and you can actually see right now we're curling down off the on the PPO after it looked like we were poised to make a bullish. The other thing to watch too on the NASDAQ 100 is this, I've mentioned before, this 40-week moving average, which is the same as a 200-day moving average when you put a 40-week moving average on a weekly chart, 40-period moving average, and that's because there's 5 days in a week. So 5 times 40 equals 200. So same as a 200-day. And you can see it's done a good job of defining, uptrends. You can see it find support. This was that deer market. Now again, a deer market's a sideways trading market, so we did go back and forth through it. That's unusual to have a 2-year sideways trading range, but you can see we were below it there. We were below it there for a while, and before that, leading up to it, that level was acting as support very well. We had a couple brief breaks and snaps back above it, or slight closes, but for the most part, it's done a good job. So you have trend line and moving average support. To watch. And like I said, my opinion, or from my experience, we're not going to limp down through there. When the real deal comes, you'll know it. It's going to happen. It's going to be impulsive. You're going to have a solid weekly close, and there will most likely be follow-up selling to that. No guarantees in investing and trading, but that's what is likely to happen. Now let's just look at a couple other things. We know that the Fang stocks, I talk about this a lot: Facebook, Apple, Amazon, Microsoft, and Alphabet. That's the G, G-O-O-G. Those are what I call the Fang stocks, the market leading stocks. The Nasdaq 100 is extremely top heavy and weighted. Those five stocks alone account for a large bulk of the returns. So what I like to look at too is the Nasdaq 100 equal weighted index, which we're looking at here. Same trend line, off the 20 off the lows back in 2018. There's your current uptrend line, and you can see the equal weighted index clearly broke down. This was a stick save. We broke intra-week. Then we closed right about on that line, stayed above it, and then boom, big red candle down with a close clearly below it. Since then, we've back tested one, two. We've had two failures to regain that trend line, and we're still well below it. So we're right now in what I call no man's land, technical no man's land. We're between support and resistance. That trend line above is resistance. You have support, around where these recent lows occurred, roughly that level there, and you have that 40-week moving average. So those are the levels you need to keep an eye on. And they go with conviction, especially on a weekly closing basis. You may want to rethink your long-term positioning. All right, and then one other way to look at the outperformance or the effect that those overloved, overowned stocks, those leading market leaders that I just mentioned have, you look at the Nasdaq Composite, because the Nasdaq 100 is simply the 100 largest companies within the Nasdaq. That's what the NDX is. The Nasdaq Composite, obviously, index has a lot more, including those names, but they don't have such a weighting. So you can see on the comp, Nasdaq Composite, here's that trend line. It's pretty clear to me. We had an impulsive red candle, break and weekly close below, followed by several back tests, and we're back testing it right now. So we're at that, we're at a pretty important technical level. If the markets can regain this level, take out the highs, they still have work to do because there's still going to be a divergent high. So I maintain that in 2018, we're still going to have a big correction. Anything's possible. I've looked for over the years. I've pointed out what looked to be more potential tops than I care to admit. But this is what it is. And sometimes those previous divergences or trendline breaks didn't play out, or maybe I was a little too liberal on the trend lines. But I can tell you right now, I've been studying these charts up and down, and that's what I'm going to do in this video is point out the levels that I see, and then let you guys decide what you want to do with this stuff. Mid cap index, MID, there it is. There's a trend line. This is what I actually have two trend lines. Let me turn that 200-day moving average down a little bit and get that clear this chart up. I had the trend line on the mid caps like this, and that shows a breakdown and a back test. But then I also do this sometimes. The trend is bullish. All the long-term trend indicators remain bullish. So we are in a bull market. You can say what you want about, like my opinion that a bear market is coming, but what the facts are is that every long-term trend indicator, those out in the weekly and monthly time frames, remain bullish. And you can just look at a chart, eyeball a long-term chart, and say this is a bull market, not anything closely resembling a bear market yet. So therefore, what I do is I call this the BOD trend line, the benefit of the doubt trend line. So I've taken it now, comes off these two reaction lows, and it captures those recent reaction lows. And this is where if the mid caps give way, it'll also take out that 40-week moving average. That's what you want to look for there. And what I like to see is not any one index. I like to see them all go around the same time, and they usually do in close proximity. Finally, this is the Russell 2000. It's been strong lately. A strong dollar hurts large cap companies and doesn't tend to affect small cap companies as much. Small cap companies do most of their business domestically, where the large caps, the mega caps, do a lot of international sales. So a strengthening dollar is not good. So we've had a nice little run compared relative to the large caps, with the small caps recently taken out, making new highs. But you can see that new high is a divergent high. I have a lot of lines here on the chart. Sorry about that, but let me just add this one. This high and any additional high, we can push a little higher. We can push quite a bit higher. This is negative divergence on the weekly chart. Right now it's in place. It's also there on the PPOs. You can see here, as I'll clean this up a little, show it to you. We do have a bullish cross, but remember, this bullish cross, like a lot of these, can be rejected at any time. And even if, like I said, even if we go a little higher, 5, 3, 4, 5, 6%, it doesn't matter. These divergences are only going to grow larger, and they portend a significant trend change, correction coming in the near future. Whether that near future is 2 days from now, 2 months, or 6 months, probably somewhere in between. But the bottom line is, that we're in a very precarious position right now. So from here, let me just run on to the components of the S&P 500. I'm going to flip to a different board here, and I'm only going to go through the top dozen or so and give you an idea, because the S&P 500 is a market cap weighted index. So these top components, for example, here is Apple, world's largest company. It's the largest component, has the highest weighting in the S&P 500, also in the Nasdaq 100. It happens to have a much larger weighting. The Nasdaq 100 is much more tilted to the top components in the S&P 500. But again, so I'm not going to cover all the 504 stocks right now that are in the S&P 500. We'll just cover about a dozen, and that'll kind of paint a picture for you that I think confirms the analysis I'm seeing on the broad markets. This is Apple. 10-year, again, we haven't moved. All these charts are 10-year weekly charts. This shows you all the divergent highs and lows, and that's when I like that's when I like to position for trend trades. So here's a divergent low right here, divergent low right here, up here. So there's your divergent lows. Those are your buy signals. We had a divergent low going into the 2009 lows, and these are your divergent highs right here. Now you may say, "Oh, Randy, well, yeah, you had point out negative divergence. That doesn't look like much." This is log scaling. Do not underestimate log scaling. I'll go back and show you what these corrections, amounted for real quick. Let's see, get that off, and okay, this correction right here from that first divergent high back then was at almost a 26% drop. And then we had, let's see, let me put the lines back on. Another divergent high here. You might say it doesn't look like much, and it wasn't very steep divergence. But with that being said, from that point, from the highs right about there, Apple fell for 4 months and dropped about 15%. And again, there's some bigger divergent highs in here. I zoomed in time-wise. Let's go back to where we were here. And again, we put on the lines. I just wanted to point out that log scaling, it may not look like much, but these are large drops in this stock. That's a 45% correction or bear market within a larger bull market. My point is we have very steep. These are some of the largest divergences we've had in the stock, and we're late in the cycle. We're 9+. This is the longest economic. We're either at or just about to be in the longest economic expansion in the history of the financial markets, as well as the longest bull market. So whether you want to call it the top or bottom of the ninth, we're right about there. So when these divergences play out, there's a good chance they're going to play out for more than a 10-20% drop. And again, it's what's important of these trend lines. Apple's got a way to go. It's up at the top of this wedge type pattern, but in a quick moving market, and we've seen this before, Apple only has to fall about 10, 11% to get down to that trend line. Not much. It can do that in a week. So that's Apple. Let's move a little faster. Amazon, great company, but here's what we're looking at. This trend line right here, Amazon's well above that trend line now, but it has negative divergence. This may not look like much, but that's divergence right there. And there's room for Amazon to kick up a little higher and still very much keep these negative divergences intact. What I have a little note here, overbought and divergent high readings. So what happens when we look at just the RSI? Let's focus on the RSI for a second. You either get what I call one and done readings or divergent highs, two consecutive overbought readings. This is a one and done. You see we're very overbought right here, and you had a correction. And again, I cannot underestimate or overemphasize. I'm sorry, I can't overemphasize the magnitude of this. This is this doesn't look like much, but there's a drop from that overbought reading right there. Amazon fell about over 16% right there, and I might not even have grabbed the high on that candle. I got to zoom in, yeah, call it 16% on this overbought reading. So that's what I look for, are these divergent highs. That's two consecutive overbought readings with the second being lower, or these one and done. And you can do this on your own chart. Go back in time, just follow the crosshairs up and look what happened every time the stock became extremely overbought like that. 31% drop. Here's an overbought reading. Again, it may not look like much, but I'm sure that's doubled, yes, over 12%. Same story here. And typically, when you get extremely overbought, you not only have a correction, but it can last for months. This was about an 8-month drop of over 15%. And so there we are, late stage in the economic cycle, extreme overbought situations. In fact, the stock hasn't been this overbought since back here in 2009, and that was in the early stages of the bull market, and it still fell for 15 months and dropped in double digits. All right, so let's move on. And here's Alphabet. Again, the common theme here is these charts look very similar. You have these trend lines. You have a lot of key market leading stocks flirting with major uptrend line support. Alphabet broke, we've been flirting with it. We've been closing on this trend line on or just above it for the last few weeks. It's very well defined, and we have, most importantly, this support level just below about 995 or so in Alphabet. All right, no reason to go over the other share class. It's basically the same company. Microsoft, extreme overbought. We have not been this overbought possibly in history, maybe back in the dot-com bubble, but at least not throughout this bull market. So we're extremely overbought, and the stock is just above trend, and that's a very well-defined trend line. So my point is, set alerts, replicate these charts, use log scaling. You must use log scaling, in my opinion, or you're rendering an inaccurate technical picture, because these stocks range. You can see a price range from $16 all the way up to 100, and you're not going to get an accurate technical picture unless you use log scaling. And you'll see, if you have these same trend lines, they're going to go off like popcorn. One week you're going to have one after another pop. It's going to be a quick move down when it comes. And again, that could come months from now if we successfully defend these levels and move higher. There's Facebook. Big divergence in Facebook. Even if it goes on to make another high, it will be a divergent high. So my most optimistic scenario has us going on in the coming weeks to months here to make new highs in the market, put in a divergent high, and then the next correction sets in. That's my most optimistic scenario right now. That can change if the technicals change. Whereas the more pessimistic scenario says that we've already topped, and this is that initial kickback rally I talked about earlier on so many of these corrections that we've had in the market, where you have the initial shot across the bow, kickback, relief rally, everybody gets excited, says, "Whew, we dodged a bullet," and then boom, the big leg comes. Big leg down, that is. There's Berkshire. This is, one of the largest. Again, these are the largest components in the S&P 500. Overbought. You can do this on your own. Just look what happened every time. That's what I'm doing. I'm clicking these extreme overbought readings, and you can see what happened afterwards. So not so good when you're very overbought and you're sitting. Look at this stock just flirting, hugging this trend line. Numerous reactions. When that goes, and it goes with conviction, a big red weekly close. Probably not going to get it this week. Today's options expiration days. They're going to park the market somewhere, probably around where they are. But just something to watch for in the coming days here. A couple more, and then we'll wrap it up. JPM, this JP Morgan Chase. See, the financials are looking very sick to me. This is a trend line. We've already broken below trend here. We've back tested it last week. We're back testing again from below this week. We have confirmed negative divergence right here on the weekly chart. That tells me that JP Morgan is headed a lot lower in the coming weeks to months. So that's my point, guys. Some of these stocks have already broken down. ExxonMobil, I don't have much of an opinion other than this stock has topped and it's gone nowhere. That's my long-term monthly chart. I made mention years ago, I thought this stock put in a generational high, and it has. It's traded since even before the last bear market. You look at where we're at. We've traded, I don't know if you can make it out on this chart. I'll give you a clean board. This is 2005 back here. This stock has gone nowhere now for over a decade. So anyways, that's it. It is one of the world's largest companies, an important component of the S&P 500, but I don't have a very strong opinion on the near-term direction. J&J, Negative divergence, right at trendline support, same story. Hate to sound like a broken record here, but it hasn't broken yet. And we're either going to hold these support levels, but I think they go soon. I tell you, I've taken all of my long-term funds are now out of 401k money and all that. Um, things where I can't short, that's in cash or bonds right now, commodities, and of course then the accounts that I can short in, that's where I'll be taking advantage of the next downturn. Bank of America, like I said, financials look sick. It's already broken down. Well-defined bearish rising wedge, negative divergences. Not much else for me to say on that one. And then there's Visa, same story. All right, I think we'll wrap it up here after two more. Wells Fargo, well, my opinion, I don't have a strong opinion on that one. There's Intel, and this is where we'll end it. Negative divergence, bearish rising wedge. Hasn't broken down yet, but it looks imminent to me. All right, guys, I hope this is helpful. And if things change and this market can somehow burn through these divergences, great. If not, you're looking at this is just, I don't know. It's fairly simple stuff to me. Like I said, I can't give any guarantees. Sometimes these things don't play out, but more often than not, when you have very clean divergence, negative divergence, especially on the weekly time frame like this is what happens. This is what those divergences mean. This was a drop of 34%. And again, this was in the middle of a bull market, and we're now still in a bull market, but by all historical accounts, at the one of the longest, if not the longest one in history. So good luck, guys. And if you have any questions, drop me a line in the trading room. For those in the YouTube channel, remember, I don't, I really don't have time to actively monitor that channel for questions and all that. You can visit right side of the chart, take advantage of our free trial period. And when I get the time, when things slow down, I usually go into the YouTube channel and try to answer questions. But I appreciate all the positive feedback and comments, guys, and members of the site. Any questions, just drop me a line in the trading room. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.